Hello, everybody. We're going to get started. We're here at 11 o'clock. Want to be respectful of everybody's time who's already logged on. I know we've got other folks logging in as we speak. So thank you for joining us. So my name is Jason Dahl, and I am a certified financial planner and the director of financial planning services here at AFS. I am here today, remotely, of course, with my colleague, Dennis Elias. You want to say hi, Dennis?
Yeah, good morning, everyone.
All right. So today, Dennis and I will be discussing understanding your HSA, which hopefully everybody who's logged in knows what that stands for, which is Health Savings Account. And so before we dive into that, I just want to quickly bring your attention to the chat feature. I believe for most folks it shows up kind of center bottom of your screen. There's a chat or a Q&A, and I think you can use either one. Dennis is going to be keeping his eye on that throughout the presentation today, and really encourage you, please feel free at any point to type in a question. We will be keeping everybody's mics on mute just to help with background noise, but appreciate any questions or comments throughout. We'll keep an eye on those. And I think we actually had at least one question came in advance asking about wanting to talk about investing in a health savings account. So I want to let you know that we will definitely talk about that. That subject. So please submit questions throughout. I also want to point out that this is being recorded, and we usually, I think, within about 2 to 3 days, we're able to get that recording, all downloaded and prettied up and uploaded to our YouTube page, and then we can also email it out to folks along with some complimentary materials that we have that go along with the presentation. So at any point, ask questions and certainly reach out with follow-up questions. Happy to talk to folks afterwards about health savings accounts or other topics of interest. All right, so let's go ahead and dive in here. We've got a lot of material to cover, so let's do it. So I always like to say financial planners love health savings accounts, or at least these financial planners love them, and hopefully that will come across as we go through today's presentation. So actually, with jumping the gun there on that slide, giving things away too soon. So I do want to say that while we're going to cover a lot of material today, really our goal is to make sure that you walk away with a better understanding of what an HSA is, if it is appropriate for you or a family member now, what to be aware of so you know if it is appropriate perhaps later in life, how to best utilize these accounts, and how to avoid some of the key mistakes or common mistakes that we see. So we're going to move at a pretty quick pace, but please do not hesitate to shoot those questions off at any time during today's workshop. All right, so here is our hierarchy of financial needs. We put this together as a team a few years back, and really it's as a result of meeting with literally thousands of people between the AFS companies and identifying really the main core question that we get asked most frequently in a variety of different ways, but it really comes back to what's the next best use for each dollar that I have, right? For each dollar that I earn or that I save, right? People just, they want to know, hey, am I making the smart moves? What's the next best thing I can do? And so this really starts from the bottom and works its way up, kind of modeled after Maslow's hierarchy of needs, if you're familiar with that. And so it starts, at a foundational level, real basic, right? Just establishing that $1,000 in emergency savings first and foremost, right? Hopefully all of you can check that box off right away. But what I want to point out is that right there at the foundation, you'll see is HSAs, the HSA savings to cover your deductible. Okay, I'll give you a little precursor now, what we're going to talk in more detail in a moment. But if you're already somewhat familiar, you know that health savings accounts are tied to high deductible health insurance plans, right? And so what we're describing here is, in addition to that $1,000 of emergency savings, another form of emergency savings is to have enough in your health savings account to cover the deductible on your health insurance plan, right? Because one of the most common emergencies that we may find ourselves in is with a medical emergency. And I almost had one right before this this webinar. I nailed my foot, and I thought, man, I'm gonna have to cancel and go to the hospital. But no, thankfully, I think it just needs a Band-Aid and some ice. but I personally have a health savings account, so I'm going to share with some of my experiences going forward as well. Also, as you scan up the hierarchy, you'll also see up near the top we have max HSA savings, right? So we're going to actually talk about the power of HSA accounts, both as a building block at the base of the hierarchy, right, establishing the core of emergency savings, right, along with the powerful long-term tax-efficient vehicle that HSAs can serve near the top of our hierarchy of needs. All right.
And Jason, I just wanted to address, we did get a question
Okay, great.
on recommendations on handling HSA accounts when approaching retirement and Medicare Part A. So we'll discuss that here in a couple slides. So
absolutely.
Just wanted to address that question.
Yeah, great. Yeah, thanks. Yeah, we will absolutely talk about that. It's one of the reasons why we love HSAs is in that very context. So HSAs offer great benefits for both young and old. Now, understandably so, the focus is typically on the role these accounts play in paying for healthcare expenses, right? So let's focus on that for a moment. This slide illustrates one example of how significant healthcare expenses can play in a financial plan, in this case, specifically in retirement, right? So regardless of how old you are or how many years you have until retirement, these accounts can really help in achieving your short and long-term financial goals, while also mitigating the impact from health risks to your plan. So during today's workshop, we're also going to highlight the savings benefits from these accounts, including the tax, emergency, and retirement savings benefits, right? So this slide is just kind of, a little bit of cold water in the face, right? Thinking about, this is kind of a national average for a retired couple. This is the average out-of-pocket expenses for healthcare and medical costs. So that would include premiums for health insurance, as well as out-of-pocket expenses for deductibles and co-pays and all of that. All right, so let's just kind of cover the basics here real quick, right? Make sure we kind of understand what is a health savings account. So these are a type of savings account that, if you are enrolled in a high deductible health plan, lets you set aside money on a pre-tax basis to pay for qualified medical expenses. All right, so let me put that slightly in different terms. They're like a personal savings account, but the money in them is used for healthcare expenses, okay? And you, not your employer or the insurance company, own and control the money in your health savings account. All right. Also, the money you deposit into the account is not taxed. Okay, so hopefully that's, perhaps some of you already know all that. If not, hopefully this has given you a good kind of basic understanding. So now let's kind of get into how they work. And I always kind of like to give just a brief sort of history on kind of where these accounts came from. So how did we get here? So health savings accounts became law in late 2003. It was a part of the Medicare Prescription Drug Improvement and Modernization Act. It was signed into law by President George W. Bush. And similar to the shift away from defined benefit pension plans to employee-owned 401k plans that has happened with retirement savings, right? The burden of paying for healthcare has also shifted away from employers and to employees. Okay, and that's kind of where health savings accounts are coming from. So I always just kind of like to say, similar to the debate between the merits of employers versus employees, kind of controlling the bulk of a worker's retirement savings, the shift towards these accounts, health savings accounts, is also debatable as to what is better for employees and employers in the long term. Now, that said, regardless of sort of where you fall in that debate or whether you care about that debate, the reality is such that we want you to make the most of what is available to you and your family through the use of health savings accounts, whether it be today or in the future.
Yeah. Thanks, Jason. So I'd just like to review a little bit about the comparisons or the cousins of the HSA. So while our focus today is clearly on health savings accounts, we just want to touch a little bit on flexible spending accounts and health reimbursement accounts. So starting off with the HSAs, as Jason said, anyone who has a high deductible health plan is eligible. You contribute the dollars. And for this particular account, the funds are portable. So if you don't use the funds, and you leave your employer, you can take those funds with you and maintain the HSA where it is or roll it into a new HSA. A lot of times you may roll it into a new HSA at your new employer. Now, in comparison, the FSA is similar, but a couple of different nuances. So this is also an account that's funded by you, and it actually doesn't normally work in conjunction with an HSA. It would be something that you have with an HMO or a PPO type of healthcare plan, but you do have the ability sometimes to coordinate it with an HSA. It is not portable like the HSA, so if you leave your employer, you can't take the funds with you. So you basically lose the funds, and it also is use it or lose it on a year-to-year basis. So the HSA, you can roll over the funds into the new year. The FSA, if you have, let's say, $1,000 left over in the FSA at the end of the year, you'll actually lose those funds. Now, some employers do have some stipulations, so they can allow you to roll over the funds for another 2.5 months or roll over $500, but you would just want to be sure how that works. Really, the most important thing with the FSA is if you do have the option to have it with an HMO or PPO, it's a good thing to fund. It's also tax-free when you put it in and take it out, so it is a nice benefit. The only thing that we'll say is don't fund it, don't overfund it. So look at your medical expenses in the past couple of years, take an average, and fund about that amount into the FSA, because you don't want to be you don't want to come to the end of the year and then have a lot of funds left over there and then just lose out on those funds. So that's the most important thing with the FSA account.
Dennis, I'm going to interrupt you just real quick, throw out, like, so anybody who has kids may be familiar with FSAs too, right? A lot of times they're used for childcare expenses. So you can get a tax break by putting the money into the FSA to then pay for eligible childcare expenses.
Yeah.
So that's another kind of context that many of you may be familiar with flexible spending accounts.
Yep.
But everything Dennis just said, kind of in terms of the strategy of using them, kind of works the same.
A lot of you may have heard, I feel like they've started to do like kind of marketing campaigns now at the end of the year for commercials and things like that. Like, come get your new glasses, spend your FSA money, because people are overfunding their FSAs. So just making sure that you fund it enough or the right amount.
Or not too much, yeah.
Now the HRA, the health reimbursement account, this is actually something that we don't see often. It is a nice benefit because it is funded by employers only. It's not funded by the employee. The only stipulation, of course, is that it's not portable. So if you leave your employer, you can't take the money with you. The funds are not use it or lose it. So as long as you're with the employer, you can roll over the funds on a year-to-year basis. One example of this, it's oftentimes used with retirees. So for example, my mom works for Kaiser Permanente. At retirement, they'll actually give them a health reimbursement account. So let's say they put $20,000 in a health reimbursement account when they retire. They can use that for qualified expenses according to the plan. So it is a little bit more restrictive because, for example, for Kaiser, you can only use it at Kaiser. But it is a nice benefit. It's kind of like a health plan pension in a way. Yeah. And they may start to become a little bit more relevant just because there were a couple of rule changes. Just FYI, employers can now offer this in lieu of health coverage, and it'll actually reimburse you for the premiums of health insurance that you get on the insurance marketplace through the states. So that's one use that some employers may look into using more. And they may also offer it in conjunction with a regular health insurance plan like HMO or PPO to reimburse you for the copays and deductibles.
But like you said, we're going to focus on the HSA today, but just
Yes.
Thanks for giving us a little bit of context there with some of the areas that we often see folks get confused, distinguishing the three. Cool, thanks. Yep.
All right, so just talking a little bit more about who's eligible. So again, anyone who's covered under a high deductible health plan can contribute to an HSA. These can be found on the marketplace, on the insurance marketplace, and through your employer plans, unlike the FSA and the HRA, which we just talked about. So in general, we would recommend the HSAs for someone who's in fairly good health, doesn't go to the doctor a lot, and is looking for low cost coverage. It is the lower cost option out of all the different health insurance plans. So that is a nice benefit. I have an HSA. I haven't gone to the doctor maybe in about a year and a half. So it's not really worth it for me to pay for a HMO or PPO that's going to be significantly higher when I can just fund an HSA, save that money for the future, and minimize my premiums. Now, maybe in 10 years, I'll have a family, maybe I'll have some health issues. So at that point, it may make sense to get an HMO or a PPO type plan.
Yeah, I always like to think about it. There's like a direct correlation between the premium level and the deductible, right? So just kind of simple. The higher the deductible, the lower the premium cost. The lower the deductible, the higher the premium cost.
Yep, yep. Yeah, thanks, Jason. Just a couple other points when it comes to the deductibles on these high deductible health plans. So there are some minimums. So for 2020, a high deductible health plan, the minimum deductible is $1,400 for single coverage, and for family, it's $2,800. So you're not going to find a plan with a lower deductible than that. And on the
And
other,
be eligible for an HSA, right?
yep, yep. And then on the other end, there is a max on the out-of-pocket expenses. So on that high deductible, that's $6,900 for single individuals and $13,800 for families.
Mm-hmm.
And then another important note, someone sent a note about Medicare. If you are enrolled for Medicare Part A, you are not eligible to contribute to an HSA. So that's an important note to make there too.
Yeah, because Medicare by definition is not a high deductible health plan.
Mm-hmm.
Yeah.
Yeah, and then let's see, we got a question here. Can you have an HSA at the same time you have an HRA through an employer? So I'll admit we're not too familiar with the HRAs, but I believe according to the new rules that passed recently that you can have it in conjunction just to help alleviate some of the high deductible health plan costs.
Yeah, that's my understanding, but it's a great question because there are many nuances in that area. I believe because the health savings account is driven by you, the employee, the individual, right? You choose your own health insurance coverage level, and then whether or not you enroll and contribute to a health savings account. That is typically kind of separate from the employer who would fund a health retirement or health reimbursement account, right? So my understanding is that, yeah, you can have both. You can have a FSA too, right? They're all sort of three distinct items. Yeah, but I don't know if there are any kind of nuances for some reason why you can't have an HRA and an HSA with the new rules. But that's something we could definitely confirm and send in our follow-up.
Yep, yep. And then we did get another question here. Is there such a concept as overfunding an HSA? So for HSA, there actually are contribution limits. So for 2020, for a single individual, it's $3,550. For a family, it's $7,100. And then you can bump that up $1,000 if you're over the age of 55. So there is a limit on funding the HSA. I wouldn't say necessarily that there's always going to be a negative effect if you overfund it. So if you have the cash flow, if you're not going to the doctor and you're looking to sock away some savings, putting it into the HSA, I think, is a great option.
Mm-hmm, mm-hmm. Yep, yep. Totally agree. So there's a couple different ways, right, to sort of think about that. Unlike the FSA, where you can kind of technically overfund it and then lose that money, right? Because if you didn't have the expenses that qualify to be reimbursed, whereas the health savings account, as long as you're funding below the IRS limit, it's not use it or lose it. It's your money. You get to keep it year over year if you change employers, if you change, health insurance plans. So in that regard, they're a phenomenal tool, and I would argue there's really no overfunding of it. And so as we go through, let's sort of share why we think it's such a great tool, right? So one of them is its tax status. All right, so as this slide says, I know it says triple tax-free, but actually I'm going to get a little wonky on you here and technical and share 4 tax advantages with health savings accounts. First, 100% deductible contributions up to the legally mandated maximum amount that Dennis just alluded to, and it's regardless of income. There are no income phase-outs like deductibility on IRAs or being eligible to make a Roth IRA, right, where some high-income folks are ineligible for making those contributions. No income limits. You can still get that full deduction for your contributions to an HSA. Second, withdrawals of your contributions for qualified medical spending never falls under taxable income, right? So as long as the money you take out of the HSA is used to pay for qualified medical expenses, never taxed. The investment earnings or interest earnings, and I mentioned earlier that you can invest, and we're going to talk a little bit about that. So any of the investment growth or interest earnings within the health savings account, those also are tax deferred, similar to being inside of a retirement account. And then the fourth piece is any withdrawals of those earnings, the investment or interest earnings, also come out totally tax-free if spent on qualified healthcare costs. Right. So from a tax efficiency perspective, these are the cream of the crop in terms of savings vehicles to be using. So I like this simple illustration to just kind of show how these accounts can serve as a bridge between healthcare and retirement spending. And I know we had a question kind of along those lines. So we know that we all know that we're going to have healthcare expenses over the course of our life, right? And as our first slide showed, many of us are going to have most of our healthcare expenses in our retirement years, right? And just like our hierarchy illustrated, a health savings account is both an excellent emergency savings tool, right? Specifically for healthcare emergencies. Also, these accounts are an excellent long-term retirement savings tool. If you recall from the hierarchy, you may remember that we even have max funding an HSA before max funding your 401k retirement account on the hierarchy, right? And that's because of all the tax efficiency components to it, right? The deductions, the tax deferral comes out tax-free, and it can serve as a supplemental retirement account when you're at age 65 and older, and we're going to talk about how that works here in just a moment. All right, so we've talked a lot about qualified medical expenses, right? So this is the part that I want to get a little technical on from 2 slides prior, right? So both contributions and any of the investment or interest earnings will come out totally tax-free for qualified medical expenses at any age, okay? If, however, any portion of a distribution, right, or withdrawal from the account is not used for qualified medical expenses, that portion of the distribution is taxable as income and subject to a 20% penalty, okay? So that's why the emphasis on this is an account for healthcare related emergency expenses up until you turn 65. Okay, so let's talk about that. So at age 65, you can take penalty-free distributions from the health savings account for any reason. Okay, so if the distribution is not for a qualified medical expense, then it will just be subject to ordinary income tax, okay? Not the 20% penalty, right? So that's the distinction when you get to age 65, right? So that's kind of why these accounts can be an excellent supplemental retirement account. Okay, so just to kind of recap, if you take a withdrawal for qualified medical expenses at any age, money comes out tax-free, penalty-free. If you take a withdrawal out and use some of it for a non-qualified medical expense, which we're going to give you some good examples here on the very next slide, then it's always going to be subject to ordinary income tax. right? It's similar to taking money out of a IRA or 401k in retirement, right? It's just going to be subject to ordinary income tax. But at age 65, you can get rid of that 20% penalty. So you can pull it out for any reason and just pay taxes at that point.
Yeah, so here we see a couple of the qualified medical expenses that we often see. So you'll see it really is a wide range: acupuncture, orthodontist, drug prescriptions, even long-term care insurance premiums. There are some restrictions there, but that is an eligible medical expense. So it is really nice. They also give you a little debit card, which I found pretty cool when I first got my HSA. But if you go to CVS and you need some Advil or you need to get your prescriptions, you just swipe the card and it comes straight out of your HSA plan to pay for that expense. Now, it is good to keep documentation, of course, just to be sure if you ever get audited that it was a medical expense. But in general, so when it comes to qualified medical expenses, the IRS actually says that a qualified medical expense are those expenses that generally would qualify for the medical and dental expense deduction. So anything that falls within that realm can be used by an HSA.
Mm-hmm.
Two questions that we get often. So gym memberships are not qualified, unfortunately, for HSAs. And then any expenses incurred before you establish the HSA are not qualified medical expenses. So you can't reimburse yourself for some acupuncture that you got a year ago, for example.
Right, prior to being enrolled in the HSA, right?
Yeah.
Yeah. Okay.
Yeah. And then another one of the items that are really nice and beneficial of the HSA is that Medicare premiums actually qualify as medical expenses. So you can pay for your Medicare Part B premiums, Medicare Part D premiums, and for any Medicare Advantage plan premiums out of the HSA. Now, as a reminder, Medicare Part A, if you didn't already know, is free. So that's why that's not included on here. But you can use it for all of these different options. They can't be used for the Medigap policies, so these are somewhat similar to the Medicare Advantage plans. So that's one thing that you can't use it for. And
yeah, we see folks get a little tripped up on that sometimes. So yeah, the supplemental insurance, yeah, is the only one that does not qualify.
Yep. Yeah, and then once enrolled in Medicare, also another important point, you cannot contribute to the HSA anymore. So this relates to Medicare Part A in particular. So once you've signed up for Part A, you have to stop making your HSA contributions. Now, this is something good to confirm with your employer. Normally for smaller companies, they'll require you to sign up for Part A, and if you have an HSA with them, you would have to stop. With larger employers, they generally don't require you to sign up for Part A, so you can continue to have your HSA and contribute to it until you sign up for Medicare at your retirement.
Cool. Thanks, Dennis. I think we've got some questions coming in, so
Oh, yes.
I'll go to the next slide. But yeah, if you want to be ready to kind of pull those up, that'd be awesome.
Sure.
So kind of given everything we've said so far, if you or a family member are eligible and are enrolled in a health savings account, then kind of I always like to say, well, what is the ideal strategy for funding the account? And that would be to immediately fund it with at least the equivalent amount of your deductible. Okay, so if you have single coverage and your deductible level is $1,400, for example, then it would be awesome if you basically just sort of take $1,400 out of your existing emergency savings, fund that right away into the health savings account. So that way you've got right from the beginning enough to cover the deductible. So in the event that you have an accident, right, and you end up having to go to the hospital or seeing a doctor and you're going to have that $1,400 deductible that you're going to have to come out of pocket, you've got it. You can pay it from the HSA if you need to, right? So that's kind of the strategy. Then, just like so many of your other savings accounts, we really recommend setting up just an automatic monthly savings plan to get you as close to that annual contribution limit as you can afford. Okay, Dennis touched on those contribution limits. We're going to highlight them here on the next slide. But Dennis, any questions we should pause on right now, or?
Sure. So we did answer one of them already, and then the other one was just after age 65, are HSA withdrawals for qualified medical expenses taxed? So qualified medical expenses are never going to be taxed, whatever age you are. After
Mm-hmm.
age 65 and up, it's only if you take money out for other expenses to just for general cash flow that you would get
Mm-hmm.
taxed.
Yep, but
Mm-hmm.
yeah, the great thing is to always remember, if the money comes out for a qualified medical expense, never taxed, regardless of age. Yeah, cool, thanks. All right, so the annual contribution limits actually adjust a little bit each year to kind of keep up with inflation. So here are the 2020 contribution limits. Just want to point out that you can no longer contribute to an HSA once you turn 65. Okay, so just one thing to keep in mind. And then the total combined employer and employee contributions to your HSA cannot exceed these limits that are set by the IRS. Okay, so if you remember, Dennis mentioned when he was talking about the differences between HSA, FSA, and HRA, one of the unique features with HSAs is that both you, the employee, and potentially, not all employers do, but some, the employer can also contribute to your health savings account. Okay, so if you have self-only coverage and your employer puts in, let's just say, $1,000 into the HSA on your behalf as a benefit that they offer, well, then you're limited to putting in no more than $2,550 in that example. Okay, so it's a combination of the contributions that cannot exceed these IRS limits. Note, if you are age 55 or above, you can add $1,000 to those limits. It's kind of what they like to call a catch-up contribution. Another important kind of nuance here is, so you can only, these contribution limits are essentially pro rata over the course of the year based on when you were enrolled in the HSA. So let's just say you were enrolled by December 1st, and then so that means, yeah, your coverage was eligible starting January 1, and then you were enrolled in a high deductible health plan and enrolled in the health savings account for the full calendar year of 2020, then you can hit these contribution limits. But as I said, proration applies, which means dividing the contribution limit by 12, and then you can contribute that amount each month you are enrolled in a high deductible health plan. Okay, so if you were only enrolled in the high deductible health plan for 6 months, well, then your limit for that year would be half of these. Okay. All right. So let's talk a little bit about investing in your health savings account. Yeah,
Jason, sorry,
yeah.
I was muted. So just got two questions in. So is the HSA contribution based on age or whether or not you're retired? So it is based upon, so you can always contribute after 65 as long as you haven't.
No, no more contributions after age 65. Contributions.
Okay, gotcha. Okay, yeah. So it was based on age or whether or not you're retired.
Yeah.
Yep,
So
yep.
it's really based on age. It's that age 65. So if you retire at 60, you could and are still enrolled in a high deductible health plan, you can still contribute to an HSA. But once you turn 65, whether you're retired or not, that's when you're no longer eligible to contribute to the health savings account.
Yep. And we got another question. Did the last slide say you cannot use HSA for supplemental insurance premiums? So that is with regards to the Medicare supplemental insurance, also known as Medigap policies.
That is correct. That is the one component of Medicare that you cannot use the health savings accounts for. So the supplemental coverage. All right. So sort of what I'll call the traditional path for Medicare is the Part A, which is free, right? The kind of the hospitalization. You don't pay any premiums for that. Then you have Part B, which is kind of like the core coverage level. You have Part D, the prescription drug, right? So those three components, the premium for Parts B and D qualify, but most people get a supplemental policy to go along with parts A, B, and D, that piece is not eligible. The alternative route, right? I just described kind of the traditional route for Medicare. There's also the Medicare Advantage plans, like the A through, what is it, G, different plan options. Those do qualify. Well, we're caught up for now, Dennis. We're good?
So one more. So
Yeah.
for the catch-up, the $1,000 catch-up, does it take effect the year you turn 55 or after you are 55?
It's based on
Good question.
the month, the actual month you turn 55. Yep, and then that proration would apply. Yep. Great questions. I love it. A lot of folks paying attention. Cool. All right. So I know one of the questions we had in advance was wanting to talk about kind of investing in your health savings account. So just like the name implies, and as we've talked about before, right, these are, most commonly used kind of like a bank savings account, right, where it's just, might earn some interest. Right, and I say might because in today's world, whose bank is paying much in interest right now? Interest rates are very low. And so, but that's kind of traditionally how most folks have their money inside of a health savings account, is just in that, little, the interest-bearing savings account. More and more now, I would probably venture to say that most of the health savings accounts now offer the option, in addition to just having the money in the savings account, to invest the money. And that could be investing in things like mutual funds, exchange-traded funds, stocks, bonds, right? And they might be tied to like an outside brokerage through a Schwab or a Fidelity or a TD, Ameritrade, those sorts of entities. And oftentimes there will be kind of two separate logins, right? You'll log into your HSA account and kind of just look at your contribution history, your distribution history, and sort of the earnings that you're earning on just the savings account piece. But then there'll also kind of be a bolt-on brokerage kind of investment option to go along with the health savings account. And that you would typically find that you would then have a separate login to look at through whether it be Schwab, Fidelity, TD Ameritrade, so forth. That's kind of how most of them are structured. And now let's talk just sort of a moment about the strategy about going about investing in them. So the first piece was just like investing in any account. Right? Whether you think about the hierarchy that we talked about, if you start at the very bottom and you think about your emergency savings, whether it's the first rung of $1,000, whether it's the second rung of having enough to cover your deductible in the health savings account, whether it's the third rung, which we hope everybody gets to in their foundation, or maybe hopefully you're all already there, is having at least 3 to 6 months of your expenses saved in an emergency fund. Well, that because it's by definition money you need to have in the event of an emergency, well, the investing should be conservative, right? Just kind of keeping it in the savings account, not earning much in interest currently, but it's also not fluctuating with kind of the markets, right? You know what it's going to be in the event of an emergency. So the HSA offers that ability to sort of do both, right? So keep a portion of it in that savings account. I would argue that at the bare minimum, you want to keep the deductible amount in the savings account piece, right? And then as you build up a balance, the amount in excess of that deductible, you can start thinking about, hey, maybe I want to invest that longer term, start taking on more. I'm more tolerant, I'm more comfortable with taking on additional risk, with the trade-off being you expect it to grow faster, right? So it's the same kind of thought process as you would go through and think about how to allocate your 401k or your IRA or your personal investment portfolio, right? Think about, okay, what's my comfort level with risk? What's the need in terms of how much do I need this money to grow, right? That's kind of the distinction of having it just in the savings account, because you don't really need it to grow there. You just want it to be what it is. And then thinking about, okay, what's my overall capacity for taking on risk? And that's kind of a reference to thinking about in the context of all of your portfolio and finances, right? Like, can you afford to take risk, or is the health savings account still truly just like the bulk of your emergency savings, right? And if it is, then you want to take less risk in the health savings account. And then the other key piece to always think about when investing is kind of what's the time horizon. Okay, all right. So if it's once you've kind of got the balance to a point where, hey, I'm good with this in terms of the emergency savings component, and now you're starting to think ahead to, hey, now I want to have a portion of it earmarked for that supplemental retirement money, then hey, depending on your age, your time horizon could be many years into the future, and so you can invest accordingly. And then same basic principles applying, right? When you move the money into like the brokerage option at the HSA, you want to think about being diversified, right? Not putting all your eggs in one basket. And a lot of times, I think initially a great way to start is the brokerage options will offer these kind of pre-mix, kind of low-cost asset allocation funds where you just sort of, based on the previous questions that we just talked about, right, kind of your tolerance for risk, your time horizon, then you can say, you know what, I want to get an account that's going to be broadly diversified, between stocks and bonds, and I'm going to pick a 70-30 fund. So it's 70% in diversified stocks and 30% in diversified kind of bonds. Right, so you can pick. I think that's a great sort of simple way to start when you first kind of open up the brokerage account, and start investing that money. Now, as those balances grow, that's the sort of thing that we all help our clients with, thinking about, okay, hey, let's look at how to invest that more proactively than in those kind of fixed investment options. How are we doing for questions, Dennis?
Yep, so just wanted to circle back here to the qualified expenses. So can you tell us how HSA funds can be used for long-term care?
Yeah.
So these are, so here on the bottom left, maybe you guys can read it. So there is a maximum annual tax-free distribution amount based on your age. So there's different ranges from like 50 to 70 or so. You can only use around like, I'm not sure the exact amount now, but I'll say like $1,000 of your HSA a year to pay for the long-term care premiums. So it's limited based on a certain dollar amount per year.
Yeah. I think the thresholds are a little higher than what you just described, but the concept applies, and that's something can certainly be looked up. I know the IRS basically issues the guidance there as to, and they adjust it not every year, but many years they kind of adjust that to keep up with inflation to say, hey, up to a maximum amount can be applied towards paying premiums for long-term care insurance policies.
Yep. And then it would just be good to confirm just that it's a qualified long-term care contract. So the long-term care contract has to state that they're eligible for as a qualified medical expense.
Mm-hmm. And I think in our experience, most are, right?
Yep.
It's pretty rare to find one that wouldn't be. Yeah. Awesome. I love it. Keep those questions coming. So we're going to, as I said, we cover a lot of stuff. We're just going to keep this momentum going because we want to be respectful of everybody's time. Keep this hopefully under an hour here. So we've alluded to this question that's on the screen right now a little bit. So let's just make sure this is crystal clear, that the funds in your health savings account are always yours to keep, regardless of your employment status or insurance coverage. Okay, so this means that if you change jobs or if you change health plans, you keep your HSA, all right? And you can spend your funds on qualified medical expenses as usual. So let's just use an example, okay? You're currently enrolled in a high deductible health plan, you're currently saving in a health savings account, all's groovy, you're building up a nice balance there. Hey, you know what, you're now changed jobs, you've gotten older, maybe now you also have some health issues, and you say, you know what, now I want to enroll in a traditional lower deductible health plan, right? So you're now no longer eligible to fund an HSA, but the money you've already funded is still yours. That's your savings account. You get to keep it. And even though you're no longer enrolled in a high deductible health plan with HSA eligibility, you can still spend the money out of the HSA for qualified medical expenses. All right. So I hope that is clear. All right, so what can you do if you are not eligible for an HSA? All right, and we've been kind of hitting on a few of these points already, that perhaps maybe once you were eligible, now you're not, or you've never been, but you're thinking in the future maybe you will be, right? So the status can change at different times, but in whatever period of time when you're not eligible for an HSA, I always kind of come back to that hierarchy, because first and foremost, the HSA at the foundation is a great tax efficient tool for emergency savings. Okay. All right, we've already kind of belabored that point. So really at that level, it just means making sure that you are funding and building up your emergency savings, right? But you just can't put it in a health savings account. Just make sure you've got it in the bank, essentially, right? As you progress up that hierarchy and you're thinking of in terms of a supplemental retirement account, well, if you're not eligible for it in that scenario, well, make sure that you're max funding your 401k. All right, make sure that you're max funding to your eligible limits for IRA accounts, right? So that it's real simple, right? There's no real science, not rocket science in that regard. It's just sort of like, if you're not eligible, okay, well, what are the other vehicles for saving to maximize? All right, so here get into a little bit of an area where some folks kind of get tripped up. So what if you inherit an HSA, or on the flip side, you're thinking about, hey, you're opening an HSA, and you maybe you already know this, right? But you are actually required as the account holder to name a beneficiary for the HSA, just as you would with an IRA or 401k, right? Or life insurance policies, those sorts of things. And like retirement accounts, the individual you name as the beneficiary then would inherit the health savings account upon your death, okay? Now, if your beneficiary is your spouse, then it's actually pretty simple. The HSA upon your death becomes your spouse's HSA, right? It just becomes their health savings account. So the surviving spouse can continue to access the funds in the HSA and take distributions for qualified medical expenses that will come out tax-free, the same way they would be if they were distributed to you, right? The original account owner. Okay. Here's where you get a little bit of the nuance, is that if the beneficiaries are someone other than a surviving spouse, the beneficiary, so let's just call it a kid or a sibling, right? Or your favorite financial planner, just gonna drop that one in there. And then the full value of the HSA would be included as taxable income in the year in which the account owner died. Okay, so if your child is the beneficiary and they inherit the HSA, whatever balance is in the HSA actually becomes fully taxable to your child, in that example, in the year that you passed away. Okay, so unless you name your spouse as the beneficiary of your HSA, the account loses its tax advantage status as an HSA upon death of the account holder. Okay, so the amount that is required to be included in gross income by any beneficiary is reduced by the amount of qualified medical expenses that were incurred by the decedent prior to death and paid by the beneficiary within 1 year of death. Okay, just kind of if I were to rephrase that, so if I have an HSA account, which I do, and I pass away in 2020, and let's just say I named my kids as beneficiary and not my spouse, well, my kids could use the funds in the HSA to be reimbursed or pay for any of my qualified medical expenses that maybe I incurred before I died, so long as they do that within 1 year of my death, and those distributions could come out tax-free. All right. So a non-spouse beneficiary does not have the option of establishing an inherited HSA, right? Unlike with retirement accounts. So this means that the option to quote unquote stretch payouts is unavailable. So some of you may be familiar with kind of that terminology when thinking about retirement accounts. It is an important distinction between HSAs and retirement accounts in that regard. Great, so we are moving right along here, and just wanted to give a couple kind of examples, simple examples, to hopefully sort of synthesize a lot of the things that we've been talking about. So here's just an example. Riley, she is age 27, annual income 75,000. She's in good health, right? Remember Dennis, right? Kind of in the beginning of today's workshop, talked about how one of the kind of criteria for most folks to think about whether it makes sense to use a health savings account. Well, first, it's required. You have to be enrolled in a high deductible health plan. So then you got to think, well, is a high deductible health plan right for you, right? And if you're in good health and you don't really use, you know, the healthcare system a lot, don't really have a lot of expenses, you know, don't have a lot of prescriptions, all that sort of thing, then yeah, could make a lot of sense to be in a high deductible health plan with the lower premium, have the HSA account, okay? So that all kind of applies here to Riley. So just simple steps. Again, nothing new here. We've already talked about all these things, but just kind of walk it through. So she's enrolled in the high deductible health plan. She opens an HSA. A lot of times the HSA, you can enroll in one that's sort of tied directly to your employer's retirement plan offerings, or you can go out and find your own HSA. You don't have to use the one that is kind of promoted by your employer. There's a lot of independent health savings accounts that are offered out there. As I talked about before, set up a monthly savings program. Right? Just be disciplined. Put that money into the account. Ideally, if you can, like, so she is single in this example. So if she's got a $1,400 deductible and she's got money in the bank that's already earmarked for emergency savings, hey, just shift $1,400 right in and make that the initial seed funding of the HSA for all the reasons I talked about before, right? To have enough to cover that deductible if, you know, knock on wood, she had an accident and had to come out of pocket for that deductible. She can do that right away. Then set up the monthly contributions. Invest in kind of that bolt-on brokerage account that I talked about. Any amount in excess or above the deductible amount. Right, thinking about kind of getting some more interest and longer term growth there. Don't forget, right, the health savings account is a complementary or supplemental emergency savings, right? So you still need to make sure that you're building and you have that, you know, your goal of 3 to 6 months of expenses. You know, if you were laid off, got hurt, couldn't work, right, lost your income, that you've got that emergency savings that could cover those expenses, right, the non-qualified medical expenses. And always remember to keep funding, putting money away for retirement, right? Because that, as we talked about early on, right, that responsibility is really shifted away from employers, and it's on all of us now. It's on the employees, the individuals, to always make sure we're saving for retirement. Last example here. So Walter is a little bit more mature than Riley. He is age 50, annual income of 150,000. Again, key criteria, he's in good health, and thus is enrolled in a high deductible health plan. The strategy, honestly, is very similar to Riley, right? With a little bit of a nuance here. So the one thing I want to point out, right, in addition to obviously opening the HSA, is and actually I would argue this is a great plan for somebody young like Riley, or somebody who's, you know, older and closer to retirement like Walter, is if your cash flow allows, try to max fund, right, up to those IRS limits. What was it for a single filer? 3,550. For a married couple, it was 7,800, if I remember correctly.
7,100.
7,100. Thank you, Dennis. Make sure. You know, in 5 more years, Walter will hit that catch-up period where he could do an additional $1,000, right? So try to max fund it. You know, get the most money in there, and don't actually use it. Right? So we've been talking a lot about today, like, oh, all the qualified medical expenses that you can use to pay tax-free. Honestly, and this is the strategy that I've employed over the years when I've had an eligible health savings account and funded it, I tried not to use it. In any year where I actually had out-of-pocket health expenses and my cash flow allowed for it, I just paid those out of pocket to let the health savings account continue to earn interest and grow and keep that tax-free status. Okay, invest it, try to grow it. And then for Walter, here's a great strategy that we see with clients. Hey, he's saying, you know what, I really want to retire by 60. Okay, so some of the key points that jump out to us then is, well, that means he's probably not going to be covered by any kind of group health insurance plan anymore, right? And he's not yet eligible for Medicare. So some of you may already be familiar with this, right? There's sort of a gap there between age 60 and 65 when he would be eligible for Medicare. And it's frightening to look at the cost of health insurance right now for somebody in that kind of window of time before they get eligible for Medicare. So by max funding an HSA now for like the next 10 years for him and not actually using it, not spending it, right? Just paying for out-of-pocket medical expenses just from his cash flow, he's now going to have a great plan and a great flexibility. So when he turns 60 and he says, sweet, I'm going to retire. I don't have that group coverage anymore from my employment, but I've got this great pool of money through a health savings account, maybe even an HRA that we talked about before, but what we've been really drilling on is the HSA. He can use that money that he's built up in the HSA to pay for the premiums, the expensive premiums before he's eligible for Medicare. So it's a great kind of strategy for some folks in that scenario. And we touched on this before, possibly, as we age and we get into retirement and kind of our insurance needs shift and folks get really serious, start thinking about long-term care insurance. Maybe you had a parent or a sibling who needed care in assisted living or a nursing home, and you're thinking, yeah, I'm getting serious here. Maybe I want to get a long-term care insurance policy. Hey, by building up that HSA balance, it gives you some great flexibility to use some of that with tax-free dollars to pay for a portion of the premium for long-term care insurance. So Dennis, let me take a break. How are we for questions? Are we caught up here?
Yep, we're all caught up. I think we're good. I just wanted to revisit one thing that we did get a couple of comments on was the after age 65 contributions. So just wanted to make the distinction between age 65 with signing up for Medicare and without signing up for Medicare. So if you're age 65 and older and you haven't signed up for Medicare at all, Part A or anything, and you're still employed, have an HSA, have income, you can still contribute to the HSA until you retire and sign up for Medicare. If you sign up for Medicare at 65, Part A or anything otherwise, generally you'd have to sign up for Part A anyways. That's when you can no longer contribute to the HSAs.
Good. Yes, thank you. That's good to clarify. It's important the devil is in the details, as they say. Cool. Yeah. So.
Oh, and we actually did. Oh, okay. Yep. Thank you for clarifying. Somebody said.
Great. Yeah. So we, as I mentioned early on, we record these. We make them available here. You can go to our website where we have workshops. A lot of these monthly webinars that we give, and some others beyond just kind of the regular monthly webinars. So we will be doing another webinar in roughly a month. I think the next one will be thinking about kind of the nuances of coupling finances. So whether you're young and getting married, or maybe older and getting married for the first time, or second marriage, kind of a lot of tips and experience that we've had over the years to go over that. So here's our team, great looking bunch. Feel free to reach out to any of us with questions, comments, feedback. If you'd like to set up a time to hop on a Zoom call and talk about your situation, happy to do that and share with you kind of our experiences and what we do. So all right, I think with that, if we're good with questions, Dennis, I think we'll call it. We did good. We're right at noon, so we kept that to an hour.
All right.
Awesome.
Bye, guys.
Thanks everybody.